Hi Matthew, I'm Jack van Heerden. I'm the CEO for Wits. We're a small cap mining company listed on the ASX with three distinctive projects that we now can develop forward. And we can discuss those three projects today. Thank you.
Brilliant. Yeah, good to see you. I saw you back in May in Cape Town. Much nicer weather than I'm getting here, that's for sure. But look, I wanted to catch up with you because you've been advancing things significantly, but in the context of your share price is off 50%, right? It's a tough market out there. So tell me, what are the things we need to be looking at in terms of what you've done since then?
Oh, thank you, Matthew. I think it's key for us when we spoke in May, the one key element outstanding for developing this mine going forward was a tolling agreement. We said from the outset that we're not going to spend capital on building a plant. In South Africa, there is process capacity available. And we were talking back then, we were talking to the two major companies here in South Africa. And then we ended up signing a tolling agreement with Sibanye Gold. That now allows us to treat our ore. And, so that really kicks off the project to put us into a position to start building the mine. That was the key thing for us. The other one was, when we also spoke in May, we just completed our feasibility study in September. But with the world gone crazy, for instance, all the costs have gone up. For instance, our diesel price have doubled from September to August. So we revised our feasibility study. The technical bit stayed exactly the same, but all the economic factors changed, and we also adjusted our mine plan slightly. And, that actually yielded an improved feasibility study for us. So where we are now, we've got a project in South Africa ready to go. All our permitting is in place. Our tolling agreement is in place. And we've got a good revised feasibility study.
Well, so how does that work then? You said we didn't change anything technical. We adjusted the pricing and we've adjusted our mine plan and we ended up at a better place. So I guess the variable there, which seems to have allowed you to end up in a better place, given the costs have gone up, is the mining plan. So what precisely have you changed there in terms of how you come at this?
Yeah, so when we did the initial early mining in basically from December until April this year, we were able then to de-risk the project quite a bit by, finishing off the box cut, gaining underground access. So where we stand now, if you walk now underground, you can see the reef is in the face. So the very first blast that we start taking now will start generating ore. And that all of a sudden has allowed us to pull back the whole mine plan. So the minute that we start now, we'll start generating ore. We'll start building a stockpile of about 30,000 tons. Once we hit that stockpile level, we'll then start feeding the plant at a rate of about 15,000 tons, building up all the way to about 50,000 tons. So that was the real benefit. We were able to sort of bring forward a lot of the ore production. And yes, it has sort of, when we also spoke, we spoke about a capital or a peak funding requirement of about 55 million. That has now slightly gone up to about 63 million. But that is then to fund, all that ore coming forward.
Okay, so right, I want to kind of get into the details, especially for people that are coming into the story new, right? So you kind of refurbished an old shaft, and that's given you sort of access to these new faces that you're going after on these reefs. But 4.2 million ounces across all three reefs. 3 million ounces is the initial resource size. I think that you're going after 3.5 gram grade roughly. What can you tell us in terms of these tons that you're building up to feed the tolling mill? In terms of how efficient is it? How much dilution is there? What's the recovery rates? All of that kind of stuff.
Look, we understand the ore body quite well. Now that we've been there, there's been historical mining that's taken place. So, and I must just stress that. If you look at the Wits, I'll give you a bit of background. If the Wits have been being mined for the last 100 years. there's mining companies right next door to our lease that's mining the same reef type as what we're planning to mine. So geological speaking, everything is very well understood. And yes, you said that you mentioned the old shaft. So I just need to stress there that even though we have equipped and refurbished and rehabilitated the old shaft, our intention is to go to a big in situ block that hasn't been mined before. So I think that's also how we differentiate ourselves. Other people have mined and gone into the old mines and started robbing old pillars there. We utilizing an old shaft, but we're going for a brand new in situ block. So I think that's critical to understand. So because of that, we've got to install new underground infrastructure. In our feasibility process, we've allowed for dilution of sort of, let's say, typical dilution factors that we understand to be achievable, and then what other companies are achieving as well. To give you an example, the minute that we'll start our horizontal development on reef. So because you've got your reef coming through your tunnel, essentially, you'll carry a bit more dilution. That's why when we start off, our typical mining grade would be about 1.5 gram a ton. And then as we open up more stope faces, where then the stoping is then concentrated, where the reef is then concentrated into a 1 meter, 1.5 meter cut, that's where you will then start seeing the 3.5 gram a ton mining grades that we'll start mining and start pushing out and stockpiling. And then once we send that to the plant, we've got a very good idea of what the recoveries would be. In the past, we've achieved recoveries in our ore similar to what all the other plants have been achieved, and we've built that into our feasibility study. So we're quite confident that we've used real values and not, let's say, optimistic values. I think the values that we've got, we can benchmark very well.
Right. So what else does the feasibility study tell you, or what are your internal economics around? Because you're ramping this thing up, right? When we talked, you thought we hope we can get to 50,000, maybe move that to 70,000, and then you got project 200,000 or project 200 at some point in the distant future, right? But between now and then, difficult economic climate. Getting pressure, so that's pressure coming from below, and then pressure coming down is the gold price is not doing what everyone thought it would do in 2022, right? So margins are being squeezed. Now, next year could be a different matter, but for now, your feasibility study says what in terms of the economics? Is this company going to make money?
Definitely. We are sitting with the all-in sustaining cost of about 1,100 US per ounce. And then at a steady state, we've got a 17-year life of mine, and at a steady state of about 50,000 ounces per annum, will be our AISC all-in sustaining cost will be running at below 1,000 US per ounce. So we set up very well to sort of trade through the economic up and down turns in the gold price. So I think we well hedged against that. I think that's important to understand. Another important factor is that, yes, even though the gold price are a bit depressed at the moment, the project is going to be South African rand based, and the US dollar exchange rate against the rand has also gone up a bit. So our rand per ounce cost, our rand per ounce revenue has actually gone up slightly, from where we were when we did the feasibility study. So in rand terms, our project is still better off than what it was a couple of months ago when we completed the feasibility study.
Okay, in terms of this tolling agreement component as well, how long do those agreements get fixed for? In terms of the terms of those agreements get fixed for? Because obviously you got to mine it and you got to transport it there, and then they're going to take their fees and then process it, and then you're going to be left with X dollars yourself. But how much control do you have in terms of those economics?
I think in terms of the terms, that was part of the, let's say, the delay is, to get a term in place and on a paper and agreed that will also satisfy the banks from which we would be seeking then debt funding. So I think that was important, and that we managed to do with Sibanye. We got that in place now. So it's also good for everybody else to understand that Sibanye is a major player here in South Africa. They operate quite a number of plants. So the onus is on us to keep on performing. So while we're performing, they will find space for us in their plants. So I'm not worried about the tolling agreement as such. It's, the onus is on us to keep on performing and to keep our place in the plant, if I can put it like that.
Right. Okay. You keep delivering, they'll keep processing.
Exactly.
That's good news. So let's talk about let's talk about the financing bit, because the capex is, like I say, moved up a little bit to 63 million. You're talking about debt there. Are we still talking about creating some sort of structured debt program which would entirely cover that capex, or are you going to need to? Are you now thinking you might need some equity element to that too?
We've employed a company called Tarum that's helping us with that's our debt advisors basically, and through the new feasibility study, they've done their calculations, and they have found that we could probably look for about 50 to 60% debt, and then essentially 50 to 40% equity. So, and that's now what we're looking for, So effectively, if you break it down, of the 60 million, we're looking for about 35 million in debt, and then the balance then through equity, And that process have now already started. They've approached a couple of senior banks in South Africa and also international players. So that process is now ongoing. And then also from an equity side, typically how it works is that, or it will work, is that you've got to spend your own money first, So, but we're also very conscious of the fact that, we don't want to over dilute our current share base, considering where our market cap sits at the moment. So we're looking at various equity options that we can bring in, So it's almost almost a chicken and egg. We need to understand what type of debt we can raise, and then we'll decide what is then the best equity split that we can then put in place.
But how do you do this? Because structured finance is going to be required here, because you're a 32 million market cap company today as we speak, right? And so some equity numbers you're talking about would be massive dilutory to your shareholders and yourselves. So in terms of things like NSRs or other kind of secured lending, or converts, or whatever that you're looking at, are those on the table? Because the thought of a massive equity dilution right now, whatever cash you may generate in the future, it's kind of not appealing, I suspect.
So we've got a couple of options that we're looking at. Convertible notes. There's a couple of companies that's approached us with streaming deals. Not all of them are I would say, lucrative for us. But, I think with our debt advisors and with the board, we'll make sure that we get the most optimum finance package, and then that will then allow us to bring in then the debt funding as well.
Because you're going to have to explain to the market, because it's a tough market out there for precious metal companies, right? It's brutal, right? Your share chart is not unusual, right? I think there's a lot of good companies in the same position as you, whose stocks are massively discounted, who are fundamentally good companies. But you're going to have to explain to your shareholders and to the market potentially that if you want to get this thing moving, and you want this thing to get to the point where it can get into production, there may be some expensive money needing to be raised. There needs to be some dilution now to allow you to get on the treadmill, as it were. That's a difficult conversation, isn't it?
It is definitely one, especially considering our current market cap. But then, and that's why we're waiting to see what the debt funding or the indicative term sheets will look like. And then we can take the step going forward, and then really understand what what's the next step for us to take, but yes, there is probably, there is money available, we know that. We know that they are, in certain cases, it will be expensive money. But I think in our benefit is that with the mine that we've set up and the way that we'll be in a position to start generating cash quite early in the project life, and remember, we're also not making massive commitments in the mine. It's not like we're building a plant where you've got to put massive money down from day one. We'll spend the 63 million over a period of 3 years. So I think that there is, we can demonstrate that there is flexibility in the way that we'll be spending the money. And yes, I believe that our share at the moment is undervalued, which we can, so hopefully if we start building this mine, we show value, the dynamics in the company will change.
Okay. Well, let's park that up, because you're, I guess, the stuff you can and can't say with regards to discussions on seeking term sheets from these debt providers, right? So I won't push you on that one. Let's talk about the two other aspects of the company. Okay, there is a JV with Rio in Australia, right? They've started drilling there, and there's also the uranium component, which is getting a little bit exciting out there. So, let's start with Australia. What's happening over there?
Well, we entered into that JV with Rio after we did that aerial surveys in 2020. And, it's been quite a bit of discussion for us to get Rio interested initially. And then when we did the aerial survey, they actually came to us and, they showed some interest in seeing what we've got in that block. And then we entered into the JV agreement where they can ultimately, if they spend about 10 million Aussie, they can ultimately grow their share holding in the project up to about 79%, something like that. And then what has now happened is they've actually started drilling on Monday, so we're quite excited to see what the results will yield. I've got nothing to announce at the moment. All I know is that, it's once again, people that didn't expect us to actually start drilling that area, but it's in a highly prospective area. We've now started drilling, so let's see what comes out. As soon as I know anything, we'll start announcing it.
Good, but they're starting to spend their $4 million commitment to get that 51% phase one. Yeah,
absolutely, absolutely. That was part of our arrangement with them, and they've honoured their arrangement, and we're quite happy. There's a good interaction between us and them. So even though we ultimately will become the junior partner, I think that the communications that we've got with them is very good up to now.
Okay, and at some point, expectation is they take you out.
Well, yes. Well, we'll end up with a 21% initially, and then after this full
phase
10 million has been spent, and then let's see what happens.
Let's see what happens. Okay, and then uranium. A very exciting uranium market out there at the moment. There's a real buzz around it.
Yeah.
You've got some uranium. Not bad grades either.
We've got some uranium. It's uranium that we identified already back in 2008. We drilled out, we had a drilling campaign there that identified an exploration target of about 12 to 16 million pounds. And we recently drilled 3 holes in that area just to confirm some of the old data, because it's a whole new management team that's looking at it. And the data that we found back in 2008 is the same as what we drilled out now. So we're confident that we're now in a position to move the uranium story forward, So the next step for us is to convert our exploration target into a JORC-compliant resource. And then once we've got that resource, we'll do a desktop study, and then we'll decide how to push this forward. What's very interesting about our uranium target is that it's on what we call in South Africa the bird reef package. In the bird reef package, you've got gold and uranium enriched reefs that sort of sits parallel to each other like this. And, in our instance, the reefs are about 15 to 20 meters apart. So even though the gold grade in that area is a bit lower than the rest of the ore body, we see a real opportunity that, with the uranium and the gold sort of mining that together, you can start building a nice little business there as well.
Yeah, no, it's interesting because if you look at Olympic Dam in Australia, they're after copper with uranium as a byproduct. Be interesting to see where you guys end up here with gold and uranium. But look, the grades are good, but what you're going to need to do is deliver a bit more scale to this. Do you think the opportunity for scale is there, given the sort of historic data that's around on this stuff?
The current exploration target that they've identified was down from surface down to a depth of about 400 meters. So the extra scale will come out on strike and in depth. So it's a localized area that was drilled out. So there's still space to the east of our license to go and explore there further, and then also to a depth of about 1,000 meters or so that we can still go and explore. So we've got phases in which we will do that. We also have to consider that we're building a brand new mine, sort of, 2 kilometers away from there. That's going to take our capital. But then we also have to be cognizant of drilling these deep holes. So we'll start off with, declaring a resource up to about, in our current exploration target area. And then we'll expand, depending on what the grades look like and those type of things.
Okay, so it's in the back pocket for now. Don't want to spend too much money and to get distracted from the main task, which is get this gold asset monetized and valued properly.
But we still, sorry to interrupt, but we still want to focus on the uranium next year. To convert our target into a resource. The deeper stuff we'll put in the back pocket.
Okay. So on, let's come back to term sheets, right? Okay, you're going through a process at the moment. Have you set yourself a date by which you want to get terms on the table to consider, or is it a kind of work in progress depending on what's happening in the market?
Well, we've signed up a number of NDAs already with some of the major banks and some of the debt funders. So it's really up to now. It's work in progress, but we expect that within the next 2 or 3 weeks, we'll have term sheets that we can consider. And then once we've got those and we see that they look, good enough for us to move into the equity space, then once we're there and we've raised the money for to start up with, then we can actually start. So we've got good plans to start early in the new year, probably get the mining contractor established in about March next year, and then start building the stockpile. So that's our. So we've got quite an aggressive ambition to get this mine now going.
Brilliant. Okay. Well, Jacques, great to catch up with you. I like the story back in May. You've moved things along significantly. Let's hope the markets recover, and let's hope you get some of the credit that I think you're due. So appreciate your time today. Stay in touch though, okay?
Oh, will do. Thank you very much, Matthew.